Good morning, everyone. Students, in the previous class, we have talked about the types of insurance, and we have discussed that we have mainly two kind of insurances, that is life insurance and general insurance. But this general insurance is including many kind of insurance like fire insurance, marine insurance, health insurance, and certain other kind of insurances. Okay, so we have already discussed about the life insurance, but today we will talk about types of life insurance policies. Okay, means the policies, so many kind of policies are available in the market, so a few important are given here. So what are those? First one is whole life policy. Students, as its name is telling, whole life policy, this policy has been taken for the whole life, means here the final payment is made at the time of death, not before that. Okay, and the premium is paid till death, throughout the life, whole life, or in certain cases if you decide it already, that can be paid for a particular number of years also. Okay, so this policy is for the whole life of the assured or until his death. Under this policy, the amount is paid only on the death of the insured. The premium on the policy may be payable regularly throughout the life of the assured or for a fixed period. All right, so that can be paid till the death of the person or can be paid for the fixed number of years also. Well, next we have endowment life assurance policy. Students, endowment life policy tells here you have the fixed time period is there, say 20 years. You have taken a policy for 20 years. So in endowment life policy, you get the payment either at the time of death or when you complete 20 years, whichever is earlier, right? So this is called endowment life policy. For example, one takes the policy for 20 years and one completes the 20 years and there is no problem, no risk to his life, still the person is surviving, so the amount will be paid on the expiry of 20 years. All right, and in the same example, suppose the person has taken policy for 20 years and the person expires after 15 years. Okay, so here the payment will be done at the time of death, they won't wait for completing the 20 years. So this is called endowment life insurance policy. Okay, and here when the person expires before attaining the age of maturity, so the amount is paid to his legal representatives. Next we have joint life policy. According to its name, joint life policy, here more than two people, they take the policy combined, like husband and wife, they take the policy, and in partnership firm, all the partners, they take a combined policy, means joint policy they take. So this is called joint life policy, and here the premium is paid together, and the payment is given at the time when even of the any of the partner expires. Okay, that time also the payment is done. So under this policy, the sum assured becomes payable on the death of any one of those whose life are assured jointly, right? Means any of one expires, so the whole payment is done to them. Okay, and same happens in the case of partnership. Next one is children endowment policy. Students, children endowment policy is taken for the education purpose, for the marriage purpose of the children, and the fixed premium is paid by the parents, and they have decided the time period, means they have to decide for how long they are taking the policy, either they are taking for 15 years or 20 years. So they are paying the premium till this time period, and when the time period gets over, means policy matures, the payment is given to the assureds. Okay, so under this policy is taken for the purpose of higher education or marriage of children. Under this policy, the insurer undertakes to pay a certain sum when the children attain a certain age. Means you decide well in advance ki after 10 years, 15 years or 20 years, you want the money back. Okay, so that way that has been decided. Well, next we have annuity policy. See, annuity policy is, it is good to take when your purpose is to have the amount, a fixed amount on yearly or monthly basis you are having. Okay, So here the amount is not received in lump sum. In rest of the policies we are receiving the amount lump sum. Lump sum means ikhatta mil jana. Okay, at the time of maturity of the policy or at the time of death of the person, the whole amount is given together. So this is called lump sum payment. But in annuity policy this doesn't happen, and generally people take this policy for their old age and for certain purpose. After retirement they need money because their earning efficiency decreases. Okay, so they take annuity policy, and they get the regular income after a specified time period. So under this policy, the sum assured is not payable in lump sum but in monthly, quarterly, half yearly or yearly installments after the assured attains a certain age. So that at the time of taking the policy, you have to decide all the terms and conditions, like how much amount you want. If you want more amounts, so more amounts policy you have to take, means more premium you have to pay. Okay, and what will be the mode of receiving the amount, means monthly you want, and quarterly you want, half yearly or annually, so that all things will be decided well in advance. So these were the types of life insurance policy, students. Now we will discuss our general insurance, and first comes the fire insurance. Okay, as its name is telling, students, fire insurance, this is a contract between the company, insurance company, and the insured, that when the fire breaks out, I mean this is the cause proxima, fire breaks out, so that the company must be compensating to the insured for the loss. Okay, they will make the losses good, and they have to pay a fixed amount of premium for this. And they have to decide the amount, means you have a big stock lying in your shop, but what amounts policy you are going to take, fire insurance kitne amount ka aap lene wale hain, that you have to decide. Okay, and insurance company is not going to make you payment more than the losses. This we have already discussed in the principles of insurance, and these will be applicable here. So here it's telling fire insurance is a contract whereby the insured undertakes, in consideration of the premium paid, to make good any loss or damage caused by fire during a specified period. The contract specifies the maximum amount which the assured can claim in case of loss, so and so. Okay, so that's the same story which I have told you. So a claim for loss by fire must satisfy the following two conditions. Okay, how you get the claim? Two conditions must be satisfied. The first one, there should be actual loss. ऐसा नहीं है कि आप वैसे ही बुक्स में दिखा दें कि लॉस हो गया है. No, the surveyor comes and he just survey the situation, then the claim will be passed. So there must be actual loss. Second, fire must be accidental and known intentionally. Sometimes people do you know what, like they intentionally create these kind of problem in their own concerns, and they keep the garbage at one place, and that they set a bezel to that garbage. Okay, so intentionally they are creating this problem, so it should not be there, right? So it should be accidental. Now contract of fire insurance is a contract of indemnity, students, right? Contract of indemnity will be applicable here, means insurance company won't pay you more than the losses. Second thing, students, the principle of insurable interest must be there. And I tell you, in fact I've told you in the starting also, fire insurance, at the time of fire insurance, insurable interest must exist at both the timings means while taking the policy also, and at the time of losses also, there should be insurable interest of the person, only then they will receive the claim. Okay, so they have taken an example. Suppose a businessman insured his godown of rupees 15,000. Okay, and the fire breaks out and the goods have burnt, and the loss is of 10,000. They have measured the loss of 10,000 rupees. So insured will get only 10,000 rupees, although he has taken the insurance for 15,000, but he will get only 10,000. Okay, because he can't get more than the losses. And another example we can say, if he has taken the insurance for 15,000, suppose loss arises of 20,000, here he will not get more than the insurance amount. Okay, he has taken the insurance, maximum insurance he has taken for 15,000 only, so he will be getting maximum 15,000 because he has paid the premium accordingly. If losses arises more than 15,000, hardly matter, he will get only 15,000. I hope it is clear. Now we will talk about the elements of fire insurance. Means what are the elements included in that? Well, that's the same thing which I have explained here. Means insurable interest must exist in the fire insurance. Second one, contract of utmost good faith should be there. Means all the information you must furnish properly. Whatever they have asked, that should be disclosed. Okay. Next one is contract of strict indemnity. Fine. Contract of indemnity must be there. Means not more than the real loss. And contract of cause proxima, means the reason of the loss. Okay, that you, I mean, reason, cause of, what do we say that? Means one cause you get insured. Means due to what, against what cause you are taking insurance. Okay, against water you are taking insurance, against fire you are taking insurance, or against natural calamity or any other thing you are taking insurance. Okay, so that is the cause proxima. So that principle must be followed. So these were your elements of fire insurance. Next we will talk about the types of fire insurance policies. What kind of policies are available? The first one is specific insurance. It's telling that under this policy, the insurer agrees to pay the loss by fire to the property insured up to the amount of the sum specified against the particular property in the policy. It's telling specific insurance. Very clearly they have mentioned, okay, कि this much amount is there of my policy, and आप जितने का लेते हैं insurance, that amount will be compensated to you. For example, a property worth 6 lakh is insured for 4 lakh rupees, and a loss of rupees 3 lakh occurs, the insured will get 3 lakh. Okay, so it's telling the value of the property is 6 lakh, but you have taken the specific insurance. Means specific amount you have told ki I want to, either this is of 60 lakh or 6 lakh, hardly matter, but I'm taking insurance for 4 lakh only. Okay, when the loss will be up to 4 lakh, so that amount will be paid to you. But if loss exceeds this limit, it is more than 4 lakh, so you will not get. Okay, I mean, you won't get extra, you will get only 4 lakh. So this was your specific insurance. Floating policy tells when the goods of the businessman are kept in various godowns and the goods are taken in and out of these godowns, then a floating policy of a particular amount is taken. At the time of fire, the estimated value of the goods is calculated and the losses are indemnified. Floating policy, here students, you have, suppose you have more places to keep the things. If one has only one go down, then this problem doesn't arises and this policy is not applicable. When you have more places to keep the goods, more go downs are there. Okay, you have taken the insurance against the goods. Your goods are lying at your shop also, go down also, and certain other places. So you have taken the insurance against the goods. Okay, so this is floating policy. Either the loss arises at this place, at another one, or at any third place. So the insurance will be there, right? So at the time of fire, the estimated value of goods is calculated and the losses are indemnified. Fine. If loss takes place, so we just estimate the loss and that will be given by the insurance company. Next is valued policy. In this policy, the value of the goods is determined by both the parties at the time of taking the policy. Generally, a valued policy is taken for those things which can't be valued at the time of loss. Here, sometime more than actual losses can also be recovered. Valued policy tells students its value is determined by both the parties at the time of taking the policy. You know what, when the loss arises, that time it is difficult to measure the loss. Means when the survivor comes, so it's difficult, that burns to the ashes and you can't find out how much loss has taken place. So when the policy has been taken by the person, that time insurer and insured, both of them, they value the policy कि इतनी value की ये goods हैं, इसका insurance किया गया है. All right. So here sometime more than actual losses can also be recovered. Next kind of policy is comprehensive policy. Well, this is all in one policy. Many things are included in that. It's also known as all in one policy, which covers losses arising from many kinds of risks, such as fire, theft, burglary, third party risk, lightning, explosion of gas in domestic appliances, bursting and overflowing of water tanks or pipes, earthquakes, flood, storm, riot, strike, etc. Such policies are generally taken by the people in the connection with the houses and household items. Such policies are not very common in India. Students' comprehensive policy, I tell you, here the premium will be very high, okay? Because when only you are taking the policy against one risk only, so the risk is less, right? But when you are taking the policy against so many risks are available on this earth, so you are taking insurance against all kind of risks, so more premium you have to pay. Fine, here we have discussed what kind of risks are included in that. I think almost all the kinds of the risks they have covered. Okay, and it will be costly, heavy premium you have to pay, and these are not very common in India, although anyone can take the policy on its property and all, and generally this is taken on the household articles, some precious items and all. Okay, now next is our marine insurance. Okay, so we will talk about the concept of marine insurance. Students, this is very important in the foreign trade. We know that overseas, if you want to send some goods and you want to have the things, so we have to cross the sea, oceans are there, so we have to send the goods through this way, oceans के through आपको भेजना होता है. So the higher the maximum risk is here. Okay, so water transport is more risky than any other means of transport. For reducing the transportation risk, the marine insurance has become very important. The shipping company undertakes only the ordinary risk. Other risks have to be borne by the exporter. Students, here 2-3 things has been involved in that. You know, here one thing is ship, right? We call it ship or hull insurance because the ship is quite costly, and the ship owners, means shipping company, those who are the owner of the ship, they are at great risk. Okay, if any problem comes, so the problem to the, I mean, so many sea problems are there, and the winds are there, and weather problems. Okay, so their ship is at great risk, so they have to take the insurance against the ship. Second thing, cargo is the goods, right, which we are sending in the ship. So the cargo owner, they take insurance on the cargo separately, they take. Fine. And the third insurance which we take, that is for the freight of the ship. Okay, means this is the shipping company and I want to send my goods. Fine. तो एक तो शिप की अपनी कॉस्ट है, इफ एनी प्रॉब्लम टेक्स प्लेस इन द ओशन, सो दिस शिप कैन सिंक, so they have to take insurance on that. Second thing, my goods will also be there, so I have to take insurance on those goods, means cargo. Third thing, there is a tie-up between the shipping company and the owner of the cargo, owner of the goods. They say we will pay the freight only when our goods will safely reach at the destination, only then we will pay the freight. Suppose any risk takes place and ship sinks. Okay, so the owner of the ship, they have an insurance, they can recover this money, right? I have insurance of my goods, I can recover the money from the insurance company. Okay, but what about the freight? Because the owner of cargo is not going to pay the freight, because we had tied up that if my goods reach safely at the destination, only then I will pay. So there will be freight loss to the shipping company, so they take insurance for this freight of insurance also. Okay, and what is applicable here? The marine insurance is a contract of indemnity, that's very clear. Nobody pays more than the actual losses, so contract of indemnity is there, and under which insurance company promises to compensate for any damage arising out of marine risk. And next it's telling the insured may be a cargo owner or a ship owner or the freight receiver. These all things I have explained. All right, students, So on this basis, we have three kind of these insurances. Ship or hull insurance, I have told, it covers the insurance of ship and its equipments. I mean, ship is not only the outer body, it's having so many other articles, assets it is having. It's containing so many equipments, furniture, fitting, machinery, tools, fuel, etc. Everything is insured, right? So this insurance is generally taken by owner of the ship. Next was our cargo or goods insurance. This is taken by the owner of the goods. And third one is freight insurance, which I have explained you just before. Fine. Now, elements of the marine insurance. What are its elements? The first one is contract of indemnity that we have discussed. If loss takes place, so insurance company won't pay more than the actual loss. Contract of utmost good faith, all the informations you have to provide properly, the true information you have to furnish. So it is based on the utmost good faith. Then insurable interest. Students, this point is really very important. Insurable interest must exist at the time of loss. Okay, see, we have discussed mainly three kind of insurances: life insurance, fire insurance and marine insurance. Once again I'm reminding, लाइफ इंश्योरेंस में कब चाहिए इंश्योरेबल इंटरेस्ट? एट द टाइम ऑफ टेकिंग द पॉलिसी. फायर इंश्योरेंस बोथ द टाइमिंग्स, एट द टाइम ऑफ टेकिंग द पॉलिसी ऑल्सो एंड एट द टाइम ऑफ रिस्क ऑल्सो. एंड इन मरीन इंश्योरेंस दैट्स रिक्वायर्ड एट द टाइम ऑफ लॉसेज. ओके, यानी लाइफ इंश्योरेंस में स्टार्टिंग में, मरीन में लास्ट में एंड फायर में जैसे इनका सीक्वेंस है उसी तरह से चाहिए. ठीक है, आई होप यू विल रिमेंबर. लाइफ इंश्योरेंस स्टार्टिंग में है तो स्टार्टिंग में चाहिए, मरीन इंश्योरेंस लास्ट में है तो लास्ट में चाहिए, फायर इंश्योरेंस मिड में है तो दोनों तरफ चाहिए. ओके, नाउ कॉज प्रॉक्सिमा मीन्स सो मेनी रीजन्स कैन बी देयर. सो अगेंस्ट व्हाट कॉज यू आर टेकिंग द इंश्योरेंस? द मरीन इंश्योरेंस पॉलिसी इज बेस्ड ऑन द प्रिंसिपल ऑफ कॉज प्रॉक्सिमा. द इंश्योरर will be liable to pay the amount of compensation only if the loss is caused by nearest reason covered by the policy. All right. I'm sorry. Now the differences between all these three, that's very easy, although we have discussed all these things separately. Subject matter. Here the subject matter is human life. Here the subject matter is some physical property, goods kind of thing. And here also the subject matter is your ship, cargo or freight. Three things are the subject matter. Elements. Life insurance has the element of protection and investment. Both the things are there. Life insurance mein safety and security, both the things are there. Okay, protection and investment also. Fire insurance has only element of protection, okay, not investment purpose, because these both are based on the principle of indemnity. Losses के time में मिलता है, बाकी नहीं मिलता है. ठीक है, so both these things are based on the protection only, not on investment. Insurable interest I have discussed just before. In the starting, both the timings, and at the end we require. And duration, policy usually exceeds a year and is taken for longer periods ranging from 5 to 30 years, means whole life policy when you can take. Here these are generally taken for 1 year. Okay, fire insurance policy usually doesn't exceed a year, and this marine insurance policy is taken for time period also you can say, and fixed voyage also, means एक जो ट्रिप होती है कि आप गुड्स यूएसए लेके जा रहे हैं तो इस ट्रिप के लिए आपने इंश्योरेंस कराया है ना, तो इट कैन बी अ टाइम पीरियड ऑल्सो एंड इट कैन बी अ वन वॉयज ऑल्सो, कि एक ट्रिप का आपका पूरा इंश्योरेंस है. सो मरीन इंश्योरेंस पॉलिसी इज फॉर वन और पीरियड ऑफ वॉयज और मिक्स्ड, दोनों भी हो सकता है. Next is indemnity. So this is not based on principle of indemnity, and these two are based on principle of indemnity. Loss measurement. Loss is not measurable because life is precious. Okay, students, in previous video I have told you life is something like I don't remember the word what I said, but that was wrong. Valueless, I have said. Life is valueless. It's not so. By mistake I have spoken. Life is very, very precious. Okay, so life is not loss is not measurable. That's very precious for its family members. And here loss, in both the cases we can measure the loss very well, so measurement can be there here. Next one is surrender value or paid up value. Students, when you have taken the life insurance policy, and after some, we have taken the whole life policy, or for the 20 years policy we have taken, so every year we have to pay the insurance. Suppose sometime in the life the time comes where you feel you find yourself uncomfortable to pay the policy, you don't have sufficient amount to pay, okay, so then you can surrender this policy, right? When you surrender the policy, so a little amount is paid to you, okay, but here we can't surrender the policies, fine. Now, policy amount, one can insure for any amount in life insurance. I've told you when we have discussed the life insurance in detail. So we can take many policies from one company even, and from the different company we can take any amounts policy, right? So there is no fixed amount, but here we take the fixed amount policy up to the amount of your goods, and till the value of your cargo, ship, and these kind of things. Next is your contingency of risk. There is an element of certainty. The event, death, or maturity or policy is bound to happen. Therefore, a claim will be present. It's telling that it is fixed that one gets the payment. All right. Either the policy matures or the death takes place. Fine. If death takes place, so the claim will be paid. And if the person has attained the age of this maturity period he has attained, so the payment will be made at the time of maturity, okay, but payment will be done. This is fixed, all right. But here contingencies are there. The event, destruction by fire, may not happen. There is an element of uncertainty, and there may be no claim. Quite possible that everything is safe, no fire takes place, so in that case no claim will be there. And same happens in this case also. Quite possible that no loss is there in the sea, no problem comes in the voyage, okay, so no compensation will be paid in this regard also, right, students? So here we have discussed the concept of marine insurance. I mean, all the insurances, life insurance, fire insurance, and marine, their differences also. Our next topic is consent of health insurance. Students, once there was a time where most of the people, they used to go to the government hospitals, and they were taking the treatment, and everything was all right. And the diseases were not like the diseases are available today. The dangerous diseases are there. And as the privatization has taken place, the private hospitals has taken place, the things became very costly, and that really became very problematic for the middle class people to take the treatment from these hospitals. So in a few past years, this policy has come in the existence, health insurance, okay. So health insurance is taken as a safeguard against rising medical cost. It provides risk coverage against unforeseen health expenditures that may result in financial hardship, right, students? The problems are taking place, the dearness has increased like anything, the cost of hospitals, medicines, everything. I mean, the medical services cost has increased like anything. So people, they have started taking the policies. So health insurance pervades following type of coverage. What it is covering in that? Here it is covering medical expenses, disability income. Medical expenses means the expenses of hospitalization, nursing, home bills, and doctor services, medicines, these kind of things, okay. So medical expenses का आप insurance ले सकते हैं. Second one is disability income, means it replaces the income lost while the insured is unable to work. Sometime one became handicapped, and certain these kind of other problems are there. Paralysis also a part of this, right? So if one takes insurance against these kind of problem, because now the person is unable to earn anything, right? Permanent disability or partially disability is there, so the person is not able to earn, right? So he takes the insurance, so that income must be, I mean, insurance company provides the financial aid in that case, okay. Now we will talk about the elements of the health insurance. Well, elements means what things are including in this health insurance. One is premium. Premium is very well known by everyone. Premium is the amount which is paid by the insured, means who takes the policy, and he makes payment to the insurer. जो insurance provide कराता है, right? उसके लिए against the risk the insured person is paying the premium. Second one is deductible. See, deductible is the amount that the insured must pay out of pocket before the health insurance. Students, if you have taken health insurance, so the treatment will be done in the hospitals, or that will be reimbursed by the insurance company. But certain expenses you have to do it already, before claiming. Okay, so the amount that the insured must pay out of pocket before the health insurer pays its share. It may take several doctors' visit or prescriptions refill before the insured person reaches the deductible and the insurance company starts to pay for care. As I have told you, if one has taken the insurance policy, so insurance company pays the bill, right? And very soon we will study about these things also. Means certain insurance company, they have their own hospitals, okay, and they don't pay in the cash. They says that you should take the treatment in our hospitals, okay, but insurance company has provided everything free of cost in the hospital. I mean, your treatment, nursing care, medicines, everything fine, but certain amounts you have paid already. When you came to the hospital, you have already visited to some doctors, you have paid the fee, and certain x-rays, certain medicines, so that is called deductible. So later on you can reimburse from the insurance company. Next one is exclusions. Not all services are covered. Students, as I have told you, that insurance company is paying for everything, okay, but certain things are not included in that. Certain exceptional cases, I mean, exceptionals are there, some exceptions are there, exclusions are there, in fact, means जो उसमें exclude नहीं है, okay. If you are treating yourself very VIP and you are providing juice, this and that, and you are hiring a taxi to take the patient to the hospital, see, we have done these expenses on the patient so and so, and one attendant is also there, you have taken 5-star room in the hospital. So these all things depends what kind of policy you have taken, okay. So some exclusions are there which are excluded from your policy. These all things has been decided at the time of taking the policy, okay. So the things which are not included in your policy, that are the exclusions, and if you do some expenses on these exclusions, so insurance company is not going to pay you for this. So not all services are covered. The insured are generally expected to pay the full cost of non-covered services out of their own pocket. All right, means non-covered services अगर आप ले रहे हैं तो आपको अपनी pocket से pay करना पड़ेगा, okay. Rest of the things will be paid by the insurance company. Next we have coverage limit. Some health insurance policies only pay for health care up to a certain dollar amount. The insured person may be expected to pay any charge in excess of the health plan's maximum payment for a specific service. In addition, some insurance company schemes have annual or lifetime coverage maximums. In these cases, the health plan will stop payment when they reach the benefit maximum and the policy holder must pay all remaining cost. Coverage limit. Students, when we take the health insurance, there is a limit, okay. Means आप 10 lakh का ले रहे हैं, 5 lakh का ले रहे हैं, 20 lakh का ले रहे हैं, 50 lakh का ले रहे हैं, so there is a limit. So coverage limit. So insurance company is bound to pay up to that limit only. If you have crossed that limit, so that excess amount you have to pay from your own pocket. Next one is your prior authorization. A certificate of authorization that an insurer provides prior to medical services occurring. Obtaining an authorization means that the insurer is obligated to pay for the service assuming it matches what was authorized. Many smaller routine services don't require authorization. It's telling authorization means the insurer takes the authorization that I'm authorized to pay for these things only. If you are doing beyond these things, so I'm not going to pay. But very small things which are not explained here, so that may be a part of this authorization. So everything, when you take the policy, so everything is mentioned in this bond. All right. So prior authorization means before handing over the policy, insurer explains everything, and that means he is authorized to do these kind of, he's authorized to do for these kind of services. All right, students. So here we have discussed the concept of health insurance and elements including in the health insurance, and it's sufficient for today. And in the next class we will talk about the types of health insurance plans and certain other things. Okay, so that will be the last class of this chapter. We will wind up the chapter in the next class, right, students? So please keep learning as usual. I'm telling you, keep learning on the daily basis. Complete your written work, prepare your notes properly, and send it on the WhatsApp timely. Thank you.